Okay. Good day, everyone. My name is Ayman Noor. I am head of office Al-Tamimi, Egypt. I am happy to be with you today to introduce my partners and colleagues, Shiraz and Yannis, who will talk to you about this very interesting and important subject of transfer pricing. Just in a glimpse, let me tell you about Al-Tamimi. We are present in 10 countries, covering all of the GCC, Jordan, Iraq, Egypt, and only a couple of months ago, Morocco. The Egypt office started in 2015 and grew from 12 fee earners to 46, covering full-fledged legal services, every type of business needs. Our focus for today is to talk about why is transfer pricing important, transfer pricing regulatory regime in Egypt, transfer pricing audit landscape in Egypt, key takeaways, and how you can be best prepared. And then at the end, there will be a Q&A session. For housekeeping purposes, this session is being recorded. We will share the recording after the session. The audience is muted. Please submit questions via the Q&A function. We will do our best to address all your questions. There will be polling questions, so be ready. If you can't hear us, please make sure you have connected your audio by choosing to either connect through your computer, audio, or phone. Let me introduce my partners and colleagues today. First of all, Shiraz Khan, partner and head of taxation. Shiraz is a UK qualified lawyer with over 19 years of international tax experience. He worked for a top international law firm in the UK and Big Four firms in both the UK and the Middle East. Shiraz specializes in advising on international tax structuring and tax aspects of cross-border M&A, private equity, structured finance, Islamic finance, and real estate transactions. He has in-depth knowledge and expertise across all taxes, including corporate tax, withholding tax, and VAT in a wide range of industry sectors. His recent experience includes structuring of various investments across Europe and the United States for a global real estate fund, including advising on tax-efficient profit repatriation and exit, as well as the tax consideration related to the financing structure. He worked also and advised for private equity firms, Gulf banks, sovereign wealth funds, Sharia-compliant banks, and regional retail organization. Shiraz had his LLB in 2001 and was admitted to the bar in 2002. Yannis Nanos, he's a transfer pricing advisor, and prior to joining Al-Tamimi, Yannis worked for a prestigious tax consulting firm in Dubai, where he was responsible for multiple client accounts across the Middle East. He also worked in London and Luxembourg for Big Four firms. His recent deals and experience include advising multinational groups in consumer goods industry, e-commerce, diversified industrial sectors, construction industry, and he assisted a multinational group within the tobacco industry on a transfer pricing audit case in Egypt. So Yannis has global understanding and local experience as well. Yannis got his Bachelor of Science Economics from Arizona. He had his Master of Science International Economics and Finance from Tilburg University. Transfer pricing is an important tax topic that impacts financial and operational performance of the businesses. We recommend that you review your transfer pricing position to ensure your business is compliant with the regulatory requirements and tax efficient. I give the floor to Shiraz now to start our presentation.
Thank you, Ayman. If we can move to the next slide, please. Yeah, if we just move on to the next slide, thank you.
Shiraz, we cannot hear you.
Can you hear me?
Yes, I can hear you, Shiraz.
Okay, great. So I just wanted to begin with a poll question. Good afternoon, everyone. So the first poll question is, how important do you consider the transfer pricing risks for your organization? Very important, somewhat important, or not important at all? It looks like that some of you haven't responded. So if you haven't responded to this poll question, if you could please respond in the next 10 seconds, and then I'll update you on the answer. So it does look like that 83% of you think that it's very important, which shows your level of understanding of transfer pricing and tax in general. So thank you. Joanna, if you could move to the next slide, please. Okay, so just to begin with, what is transfer pricing and why is it important? I think the clue is in the name, transfer pricing. So clearly, transfer pricing has something to do with pricing, and it's to do with pricing on transfers. So when you're selling goods or services, or you're receiving goods or services, that's when transfer pricing is relevant. And taking the next step is actually relevant, not just in a general context, but when it comes to related party transactions. Now, why is this the case? Why is it important? For tax reasons. When you have a related party relationship, you could influence and manipulate the price in a way which allows you to achieve a tax advantage and enables you to reduce your tax burden. And in a similar situation, if you were contracting with third parties who are unrelated to you, you wouldn't be able to do that. So for example, I mean, just to ignore the situation of companies, if you have a brother, if you have a sister or your parents and you're contracting with them, you could agree with them whatever price you want. But if you're trying to sell to a third party, you want to obviously maximize the price, but the purchaser, we want to minimize the price. He won't agree for you to reduce the price because he wants the price in the market. So that's why related party relationships and transfer pricing is important. Just to start off with this example, so you have effectively a company A in one country, which has a 0% tax rate, and you have company B in another country, which has a 20% tax rate. So company A is actually selling to company B some goods, let's just say, for example, and the price is $250. Now, if company B sells to third parties for $300, the profit which will be made by the company B will be $50. And if the rate tax rate is 20%, the tax will be 10%. You could see that the price at which company A is sold to company B of $250 is actually taken as a deduction by company B. So if, for example, the market price was 100 and you effectively increase the price to 250, you could pay less tax. If you were to reverse the situation and effectively the company B was actually selling as opposed to buying, company B, because it's paying tax at 20% tax rate, would actually want a low sale price. So therefore, instead of 300, the price it would want is maybe 50. And therefore, it could pay less tax. So the issue with transfer pricing is once you have a related party relationship and you're related, you could influence the price, and therefore by either reducing your income or inflating your expenses, and therefore reducing your tax liability. And therefore the tax authorities are very keen to look at the prices between related parties and make sure there's something called arm's length. Arm's length principle is effectively the price you would agree between two parties that were not related. So the test is that if you're related parties, you should make sure that you comply with the arm's length principle, which in turn means that you should make sure the price is the price that two parties would agree had they not been related. If we can move on to the next slide, please. I guess the importance of transfer pricing was enhanced by a project called the BEPS project. I don't know if you've heard of the BEPS project. So the BEPS project stands for Base Erosion and Profit Shifting. So back in 2008, 2009, as you know, there was a global recession, and because many countries rely on taxes as the main revenue generator for them. So therefore, tax is very, very important. Now, in 2008, 2009, because of the recession, many countries went into budget deficit. So they were looking at new ways to bring in revenue, to increase the revenue, to tackle the budget deficit. And tax is obviously a key component. And these countries, they were very, very worried that many companies were set up in a way to pay less tax. So you had multinational companies, global companies, which were operating in many different countries. And although it's a global group, it's essentially one group. So effectively, what these companies were doing, they were shifting profits from high tax countries to low tax countries, and therefore paying less tax. And they were using the international tax rules at that time, which were considered to be out of date, to actually benefit from double non-taxation. Now, there were double tax treaties in place between countries, and the purpose of these treaties is to eliminate double taxation and to allocate taxing rights. However, these companies were effectively using the treaties, so they have a double non-taxation. And in this BEPS action project, what happened was the G20 countries approached the OECD, which is the International Tax Organization, and asked them to look at ways in which they could tackle and counter this base erosion and profit shifting. And the OECD actually undertook a project. They recommended 15 key action points which countries should implement. And in particular, certain members, which are called BEPS inclusive members, and Egypt is also a BEPS inclusive member, they agreed to implement 4 minimum standards, which came from these 15 action points. Now, a key focus of the OECD BEPS project was actually transfer pricing. As I mentioned, a lot of multinational companies, they were shifting profits from high tax countries to low tax countries. And although the purpose of transfer pricing was to make sure that the pricing is consistent on an arm's length basis and reflects effectively the functions, functional profile, the assets, the risks, what a lot of companies were doing effectively, they were determining the price or manipulating the price based on these factors in a way which is not commensurate with the value. So the whole focus of the BEPS project in terms of transfer pricing was to align effectively the value and the taxation, the price and the taxation with the value. And there were 4 action points which actually dealt with transfer pricing, 8, 9, 10, and 13. Now this BEPS project is also culminated into another project called the BEPS 2 project, and you probably heard of it. And in the BEPS 2 project, there's actually 2 pillars. Pillar 1 deals with the allocation of taxing rights, and Pillar 2 effectively imposes a global minimum effective tax rate of 15%. So yeah, I'll just going to hand over to Yanis now for the next section.
Thank you, Siraj. Thank you, Siraj. So if we can go to the next slide, please. Thank you, Joanna. So in this section, we're going to talk about to give an overview of the historical development of transfer pricing in Egypt, and as well an overview of the transfer pricing requirements in Egypt. To start with, transfer pricing was introduced in Egypt in 2005. Article 30 was the article making reference to Amsterdam principle and as well on transfer pricing. Later on, in 2010, the Egyptian tax authorities issued the first draft of the Egyptian transfer pricing guidelines, whereas it was introduced the preparation of TP documentation and it is submission upon request. Following, as Sira said, the BEPS project back in 2015, in 2018, Egypt introduced mandatory preparation and filing of the so-called three-tiered transfer pricing documentation, namely master file, local file, and country-by-country reporting. So this was introduced in 2018, and following this in 2020, with the introduction of the Unified Tax Procedures Law, transfer pricing was as well part of the Unified Tax Procedures Law, and the specifics about transfer pricing was the introduction of penalties related to non-compliance, basically penalties in case of that taxpayers do not file their transfer pricing documentation. Later on in 2021, there was in the executive regulations in relation to the Unified Tax Procedure, basically again giving further guidance on specific transfer pricing terms. So John, if we can move please to the next slide. So just to give a bit of overview here in terms of the transfer pricing documentation, there are three key reports. The first one is the master file. The master file gives an overview of the business of the group. Then the local file that contains more detailed information around the local entity, the local taxpayer. And the last is the country-by-country report that shows the global allocation of income and taxes, and it also includes some other qualitative information. Now, to go one by one and to have be more specific, in terms of the master file, the content is basically what is required to be part of the master file. You need to have an organizational chart, needs to be there as well, an overview of the businesses. When we say about overview of the business, we mean about the supply chain, description of the supply chain, description of the key value drivers, a high level of function analysis as well. Apart from this, there is a requirement to have as well the list and a description of the intangibles. What is the R&D, research and development policy within the group? What are the strategies? What are the key arrangements with regards to intangibles within the group? Another section is as well around financial activities. So the group needs to make reference how it is financed, including as well financing from third parties. And this is basically the key information that should be part of the master file. Usually, the master file is prepared at the headquarter level. Now, in terms of the local file, that, as we said, provides more information, specific information on the local taxpayer, the local file, the content of the local file is basically, firstly, a description of the local entity, meaning the management structure, the local business strategy that is followed by that entity, a description of the control transactions, the type of these transactions, if it is management services, royalty payments, etc. Apart from this, then is as well the function analysis that is an important part of the local file as well. And to continue as well, the financial information around the entity and as well a key component of the local file is the economic analysis, what we call in transfer pricing typical benchmarking study. So basically means a search for comparable companies to assess the arm's length nature of the control transactions. The local file typically, because of the nature as well of the work required, is prepared by the local taxpayer. Now, in terms of the country-by-country report, it's a document that includes information that have qualitative and quantitative nature as well. There are basically three tables. Table 1 includes information around the allocation of income per jurisdiction, the taxes that have been paid per jurisdiction, the number of employees, the state capital, etc. Financial information per jurisdiction for the group. Table 2 includes some qualitative information, let's say what are the specific activities performed by the entities, if it's a distribution company, if it does procurement or head office, etc. And then the last part of table 3 includes some information on the preparation of the CBCR. So basically, what was the currency used, what is the source of the data. And we should also mention as well, typically the country by country report, because of the type of information that they are required, is prepared at the headquarter level. So having said that, if we, Joanna, please, we can move to the next slide, please. Thank you, Joanna. So in terms of the transfer pricing compliance requirements in Egypt, this table gives an overview. Since the Unified Tax Procedures Law that was introduced in 2020, there are thresholds for the preparation of the local file and the master file. Effectively, taxpayers with aggregate related party transactions above 8 million Egyptian pounds, they need to prepare and submit a local file and a master file as well. In terms of submission for the local file is 2 months after, within 2 months after you have filed your income tax return. In terms of the master file, there are 2 types of deadlines. If in case you are a group headquartered in Egypt, then the master file should be submitted together with your local file. In case you are a group that is headquartered outside Egypt, the deadline for filing your master file follows the deadline of the income tax return filing for the ultimate parent entity. In terms of the country by country reporting, there are different thresholds for Egyptian headquarter groups versus non-Egyptian headquarter groups. So for Egyptian headquarter groups, it's a lower threshold compared as well to the OECD threshold is 2 billion Egyptian pounds, around 150 million euros, basically. So groups that they have consolidated revenues above 2 billion Egyptian pounds, they need to prepare the country by country report and submit that to the ETA. Whereas in terms of Egyptian subsidiaries of foreign groups, the threshold is euro 750 million, as is the guidance from the OECD as well. The key thing is here that Egypt does not require the submission of, for the time being, of the CBCR report for non-Egyptian headquarter groups. It's in case of Egyptian subsidiaries of foreign groups, it's only required the CBCR notification to be submitted. The CBCR notification, the deadline for this is basically the end of the fiscal year in Brussels, and in terms of the country by country report, taxpayers, they have 12 months after basically to file the country by country report. Now, with regards to the disclosure form, this is part of the income tax return. It was always part of the income tax return, but historically, it has been seen that taxpayers were not always filling in that form. So the ETA decided to make it mandatory to fill in the form with the related party transactions. And in case of non-compliance with this, there is a specific penalty of 1% for the value of the undisclosed transactions to be applied with regards to the disclosure form. The specific and the important thing about TP documentation in Egypt, and this is in contrast with other jurisdictions, is that there have been introduced specific TP penalties with non-compliance with the transfer pricing documentation. So that means that taxpayers need to take that seriously, and they need to make sure that they comply. These penalties can vary from 1% to 3% on the value of the total value of the common transactions. The maximum can be up to 3%. So taxpayers need to keep that in mind when they prepare their TP documentation. So having said that, John, if we can move please to the next slide. Thank you, John. So on this now part, we have basically summarized a few areas, a few points that are specific to transfer pricing in Egypt. As you can imagine, as any type of regulation, there are some specific requirements coming from Egypt. Egyptian tax authorities and the Egyptian transfer pricing guidelines follow mostly the guidance from the OECD. However, there are some areas that are unique to Egypt. Firstly, there is a requirement for preparation and submission on an annual basis of transfer pricing documentation. That means that taxpayers need to retain contemporaneous documentation. The other that is quite important and unique in Egypt is basically the benchmarking study, the approach. So the Egyptian transfer pricing guidelines stipulate that taxpayers need to follow a hierarchical approach with regards to transfer price, with regards to the benchmarking study. What does that mean is basically that they need to show in the benchmarking study that the taxpayer has searched for local comparable commons. If he cannot identify local comparable commons, then he looks for regional comparable commons. And then if not enough regional comparable commons have been identified, then we need to go for global ones. The key thing here is that taxpayers need to remember is that basically they need to demonstrate in the economic analysis that they have followed that approach. Because also as part of the latest unified tax procedure guidance is that the tax authorities have the right to disregard the OTP documentation if it doesn't follow exactly the law as stipulated by the Egyptian transfer pricing guidelines. There are also, as we said, specific penalties with regards to non-compliance with TP. There is as well the so-called four-step approach that is followed by the Egyptian transfer pricing guidelines. Basically, this is a framework to come up to an arm's length result, specific steps that they need to be followed. And these steps, by the way, they also need to be reflected in the preparation of your local file. So ensure that you are basically, whenever you prepare your TP documentation, you are following the guidance as it is from the Egyptian transfer pricing guidelines. And in terms as well of transactions, all intercompany transactions from management services, interest payments, guarantee fees, etc., they are all in the scope of transfer pricing, and as well domestic transactions are also there is no exclusion for domestic transactions. Joanna, if you can move please to the next slide. Thank you. I think Siraj now you can.
Sure. So we have another poll question here. Is your organization ready to meet the Egyptian transfer pricing compliance requirements for the financial year 2021? So we have extremely ready, somewhat ready, or not ready at all. Thank you for your responses. So we effectively have around 85% of you are either extremely ready or somewhat ready. There's almost around 12% of you who are not ready at all. So it looks like you're keeping abreast of all the requirements on top of things. Just moving on to the next slide. Thanks, Joanna.
Thank you, Joanna. So in this section, we're going to talk about the transfer pricing audit landscape in Egypt. We're going to give firstly an overview of the tax audit process in Egypt and specifically the transfer pricing audit process. And then we're going to talk about the approach of the tax authorities, what we have seen from the ETA so far, and what are the common areas of focus from the tax authorities in Egypt. So Joanna, please, if we can move to the next slide. Thank you. So in terms of the audit process in Egypt, it pretty much follows a typical tax audit process in Egypt. So I will say that effectively is the audit process in Egypt is basically it can be split, grouped basically in three basically stages. The first stage is the administrative stage where the ETA is requesting information from the taxpayer. Is basically the initiation of the discussion with the taxpayer. There is requesting information. This can be in the form of a local file or of the financial statements. And based on this review of the documents that have been served by the taxpayer, the tax authorities are assessing the validity of the information as well, and then they come up with their own views and their own assessment. And then the next stage is basically what is called the committee stage. At the committee stage is effectively split in two parts. One is the internal committee stage, and the other part is the appeal stage. So in the internal committee stage, the taxpayer has the right to request for another review from the specific department in terms of the assessment issued by the tax authorities. This department independently will investigate further the assessment, and then we may have a compromise and we may reach a conclusion at this stage. If not, and if there is another objection, then the next stage is at the appeal committee. Whereas the appeal committee, again, will assess the view of the internal committee and also the view from the taxpayer. At that stage, again, there is the possibility of a compromise. If there is no compromise, the decision basically of the appeal committee is binding upon both of the parties of this case. In case that there is an objection, then the last and final stage is the court. This is basically always an approach, and I mean, we don't recommend clients and taxpayers to reach at the level of the court, because at that stage it's a time-consuming process, and as well it's a process that it is also it's not efficient from a cost perspective, and also will take time to take the final decision. So the recommendation is always to reach a compromise and basically conclude the case and close the case as soon as possible. Having said that, I think we can move to the next slide, Joanna. Thank you. So in terms of now of the audit environment in Egypt, and also together with the things that Sira said before about the BEPS project, and that the tax authorities are, in search of tax revenues globally, Egypt is not an exception. So Egypt as well is, the Egyptian tax authorities are pretty much doing the same. They are also using transfer pricing as a Trojan horse, as a tool basically to investigate the tax and transfer pricing position of the taxpayers. So this can be seen in multiple different ways in Egypt. Firstly, we know that the tax authorities in Egypt have hired a great number of people, transfer pricing professionals. Also, the ETA has its own databases. So basically, whenever you do a search, they can replicate that search, the benchmark search, they can replicate that search, and they can, they can see if your results are consistent or not. Apart from hiring more people, they have also been training people, extensive training on transfer pricing to educate people and also to level up basically the quality of their reviews. Not to forget to mention that since 2018, that the TP documentation is mandatory to be prepared and filed. You can imagine that the tax authorities have an enormous amount of information at their hands right now in terms of transfer pricing documentation. Having this information at their hands, it has helped as well and boost the tax and transfer, specifically the transfer pricing audits. Tax authorities are asking multiple questions around the local file and try to find any inconsistencies or any areas that can be weak for the taxpayer. That's why we always recommend that you prepare your TP documentation. You should consider it as your first line of defense. This is your story towards the tax authorities, and it's up then to the tax authorities to evaluate this story and see if this story it makes sense, it's reliable, or it's consistent with the reality as well. Not to forget to mention as well that transfer pricing is part of the overall tax picture. There is also a connection with an interplay with other taxes like custom duties. So basically, you are importing goods from a related party. If you change the price of the importation, this can have an impact on your custom duties. And all of this environment has resulted to a significant number of taxes adjustments. We have seen that tax authorities are also challenging the transfer pricing methodology used, and as a result, the arm's length, nature of transactions that at the end has brought up a lot of cases of, tax adjustments. So I think on the next slide, Joanna, please, we can move. So this slide is over the key areas of concerns for taxpayers with regards to transfer pricing. It's pretty much similar picture as well what we have seen in other jurisdictions in the Middle East, and I think this is the hanging fruit for the tax authorities. It's very easy to attack these areas. So to start with, and based as well driven by the BEPS project, transactions with low or no tax jurisdictions. This is an area that has attracted the interest of the tax authorities. When you have this kind of transactions, then potentially tax authorities may consider that you try to allocate income in a no tax or low tax jurisdiction. Another area is companies that have recurring losses. In case you have 2 or 3 years loss on a row, tax authorities may question why you have these losses. Is this based on business reasons or it's because of your transfer pricing arrangements? That's another area as well of focus from tax authorities. Then as well, any kind of payments, if you have payments with regards to management services or with royalties, tax authorities can always challenge the deductibility of these expenses if they are at arm's length, and especially for, as an example, for management services, are you receiving any benefit? There are a lot of questions around, and there is a lot of documentation that needs to be prepared to demonstrate that you have an arm's length value set in terms of the management services, that you have followed the appropriate methodologies, questions around the markup applied, or if it's a direct or indirect cost. Apart from this as well, last but not least, is also the financial transactions on transactions with regards to, intragroup funding, treasury activities, guarantee fees. So all of this, in the at the focus of the tax authorities. That's basically, these are the key areas of concern we have seen so far from the tax authorities. So if we can move please to the next slide.
So next poll question, how prepared are you to handle a request for transfer pricing audit or transfer pricing related information request from the Egyptian tax authority? Thank you, everyone. It looks like some of you are well prepared. 27% of you, most of you are somewhat prepared, but probably could do with some additional assistance. And again, around 14% are not prepared. Thank you for your responses. Now, just moving on to the key takeaways, if you could move to the next slide, Joanna. So I guess, as Yanis mentioned, I think one of the key takeaways is that you do need to maintain robust and contemporaneous transfer pricing documentation to support the nature of your transactions. And this is a requirement under the law. And if you don't maintain this documentation, there could actually be penalties, and it significantly increases the risk that you're unable to defend your transfer pricing position before the authorities. So it's very, very important to maintain this documentation. Also, because Egypt, things are constantly evolving, it's important to make sure that you keep abreast of the specific documentation requirements. And again, documentation is very, very important. It allows you to defend your position and to mitigate any unnecessary audit risks. If you've documented it already, you're in a better position because it shows that you've thought about things and enables you to do things you wouldn't otherwise be able to do. If you don't document it initially, you're non-compliant with the law, and also then whatever you have becomes less credible as well. So it's very, very important to make sure you comply with these requirements. Also, you need to make sure that you have an effective strategy for handling and dealing with transfer pricing audits. So do you have, for example, the internal capability? Do you have the resources? Is there something that you need to outsource? The tax authority may come to your premises, they may review your documents as well at your premises. Do you have people who could manage that and deal with that for you? When the tax authority answers questions, obviously in terms of them assessing additional amounts of tax, your responses play a key part. So do you have the right person to answer those questions, to understand what risk arises as a result of those questions, and what the tax authority may be geared at? Also, you need to also explore, alternative methods, because of course, if you have a transfer pricing dispute, and then you need to go through the courts and litigate, and that can be quite costly. Some taxpayers like to have upfront certainty, and you could explore alternative methods of dispute resolution. For example, having an advanced pricing agreement. If you have an advanced pricing agreement, before you enter into the agreement, you could discuss with the tax authority what you're looking to do, what the transactions can be like, what the risk profile is, what the assets are, what the risks are, and you could agree with them. And this gives you upfront certainty. And of course, then it enables you to completely avoid the dispute which would arise. If you can move over to the next slide, please. So yeah, I mean, in terms of how how you could prepare and also how we could assist you, I think the first thing is to review all your intercompany transactions and your business model, understand any risks which arise from them and how you can mitigate them. Also, what you should do if you operate in many countries, you should perhaps have a transfer pricing policy in place for all your intergroup transactions. And this actually helps as well with the tax authority and mitigating the risk. So you should have a policy at the group level where similar transactions are treated in the same way, and also in terms of your risk appetite. You should also implement your transfer pricing policies. You should prepare agreements between for intercompany transactions, and the agreements should perhaps be a little bit different to third-party agreements. So they should take into account specific factors related to the fact that you're a related party. You should also maintain all internal documentation, for example, invoices, contracts, and any other discussions to evidence the arm's length nature of the transaction. In terms of documentation, you should of course prepare your transfer pricing documentation, which is, as Yanis said, master file, local file, country by country reporting. You should prepare the benchmarking analysis to support the pricing of the intergroup transactions, and the transfer pricing returns and disclosure form, as well as the transfer pricing documentations and returns where required. You also need to, once you've submitted everything, you also need to think about what will happen after you've submitted it. So in terms of queries from the tax authority, in case they open up an audit, how would you manage that? And can you have discussions with the tax authorities in advance to actually come to an agreement with them on your transfer pricing position? Can we move to the next slide, please? So these are just some of the areas that we could assist you. We could help you doing a risk assessment. We could also help design your transfer pricing policy. We could assist you with the implementation of the policies, with your transfer pricing compliance, so preparation of the documentation, the benchmarking, and after you've submitted all your transfer pricing documentation and there's some queries from the tax authority, we could assist you with the audit and the queries. Move on to the next slide, please. So now we move on to questions and answers. So if you have any questions, please drop them in the Q&A box. We already have a few questions, which we'll deal with in a short while. So now the first question, which is quite a general question, which always comes up, is there any specific format for the local master file and local and master file?
Thank you, Shiraz, for this question. So that's a typical question that comes from from many clients. I mean, in Egypt, as I said before, the Egyptian transfer pricing guidelines, they follow closely the OECD. However, there are a few differences in terms of the local file and the master file, especially for the local file. There are a few differences in terms of the industry analysis that the taxpayers need to consider about. Let's say, as an example, SWOT analysis or competitor analysis. These things need to come across and be part of the local file. But I can say that it's very closely to the content of the OECD standards.
Thanks, Yanis. There's another question here, 750 million. Is this group revenue in case of subsidiary or foreign company?
This is the group revenue. Yeah, that's the group revenue.
Yes, Yanis mentioned earlier in the presentation, this is effectively the consolidated group revenue. So this would be the revenue in your consolidated financial statements. So the next question, should the local file and master file be prepared annually? I could deal with this question. So there's no specific requirement in terms of, for what period should the documentation be kept, but there is a specific requirement for the documentation to be contemporaneous, which means that every time you submit your tax return and submit the documentation, it should be up to date. And the only way you're ensuring that is that if you actually update it on an annual basis before you submit it. So yes, as a result of that, you do have to prepare the local file and the master file on an annual basis. The next question, are there any specific local requirements applicable in relation to search for comparables?
I mean, yeah, this is something that was covered previously with regards to the, the hierarchical approach in terms of the TP documentation, the benchmarking study. So basically, as we said before, the taxpayer needs to look for local comparables. From our experience as well, we have seen that it's quite difficult to find, a solid number of Egyptian comparable companies. Typically, we include local comparable companies if we can identify them. Then also we expand to look for regional comparable companies. So usually, when you want to prepare a benchmark study for Egyptian companies, you will have a regional benchmark study, meaning you have comparable companies from the whole Middle East. Sometimes you can even further expand if it's not enough, and you can also include comparable companies from Eastern Europe or other jurisdictions. And then the last part is basically if you don't find enough comparables even at the regional level, then you have to move at the global level. I mean, yeah, depending on the nature as well. If you have, let's say, loans, that's quite common to look for, global data. But this is the key thing that taxpayers need to remember is basically you need to demonstrate in your benchmark study that you have followed that approach, because if you haven't followed the approach, looking for local, regional, and global data, the tax authorities can disregard your benchmarking study and they can say that this is not in line with the Egyptian transfer pricing guidelines.
There's another question here. For which tax year should the first TP documentation have been filed in Egypt?
Yeah, I mean, as I said before, it became, I mean, in the law, absolute principle was applicable, was existing since 2005. However, the mandatory nature of the submission of the TP documentation came in 2018. So from 2018 onwards, taxpayers, they need to maintain and submit transfer pricing documentation. And if they haven't done this, there are also penalties that can be applied, that are penalties specific to non-compliance with this rule.
There's another question here. How are low-value intragroup services treated in Egypt? Is this an area of dispute with the ETA?
Yeah, I think this is again a common type of question and a common area, but it's I will say that largely again Egypt follows the guidance from the OECD So basically, specific chapter in OECD deals with low value adding services. If the approach has been followed in accordance with the guidance from the OECD, I think the risk for a client, for a taxpayer to be challenged on their on the markup applied, it should be considered very minimal.
Thanks, Yanis. There's another question here. Is there any risk from a TP perspective regarding cash movements between subsidiaries?
Yeah, I think this is a very good question. So basically, yeah, I mean, firstly, it really depends where are these subsidiaries. I mean, typically, if they are within Egypt, someone may say that if it's within Egypt and there is the same corporate tax rate applied, that the risk is minimal. Again, someone needs to check these transactions and also see if these transactions are movements that are going through the P&L. When these movements are going through the P&L, then they should also be considered, and they should be reflected as well in the local file.
Yeah, I think it's also important to ensure that where you have cash movements between subsidiaries, which are of course related parties, you need to understand the underlying nature of the transaction to which these cash movements relate. So therefore, I mean, cash movements can attract scrutiny from the tax authorities because they want to understand that what the movements relate to and do they reconcile. So they could result in some scrutiny from the tax authority. So just moving on to the next question, should the local file, master file, be translated into Arabic?
I mean, we haven't seen, that's another common question as well. Tax authorities like the DTA is fine with having the English version of the local file and the master file. So taxpayers, they can prepare these documents in English as well.
Okay, the next question, what is the process for submission of the local file, master file, CBCR?
So I think that's again a good question because it's a different treatment. So in terms of since last year, basically in terms of large and medium taxpayers, the local file, the master file can be submitted, and as well the CBCR on the ETA portal. Whereas for smaller taxpayers, then there is a requirement for filing a hard copy to the ETA. This is a process. This is what we expect as well to be happening as well for this year.
Next question, Yanis. Is there a requirement for the submission of the CBCR report for non-Egyptian headquartered groups?
Yeah, that's what we also discussed previously. So basically, because Egypt effectively follows the guidance on CBCR from the OECD. However, it hasn't signed any bilateral exchange of information of CBCR with other jurisdictions. So for the time being, Egyptian tax authorities require only submission of notification, CBCR notification for non-Egyptian groups. Egyptian headquarter groups, that also there is a lower threshold as well for them. It's not 750 million, but it's 150 million approximately euros on consolidated revenues. They need to prepare and submit their report together with the notification. So if you are a subsidiary of a foreign group, it's only the CBCR notification. If you are a group headquartered in Egypt and you are above the threshold, you need to prepare together the CBCR report and the CBCR notification.
The next question, Yanis, are there any specific transfer pricing penalties for non-compliance with TP documentation?
I think it was also covered that previously as well. As we said, it's basically they range from 1% to 3% on the total value of the intercompany transactions. The maximum that can be applied is up to 3% if you haven't prepared your disclosure form in line with the requirement. Then the penalty can be 1%. But the key message is that your The penalties that can be applied can reach up to 3% of the total value of your intercompany transactions.
Great. Thank you, Anis. I think that thank you so much for attending the presentation today and taking your time out. We will of course send you a copy of the presentation shortly. If you have any further questions, please don't hesitate to contact us and reach out to us. And of course, if you need any assistance in relation to transfer pricing, we're here and available and ready to assist you. So thank you everyone for attending, and we hope to hear from you soon. Thank you.
Thank you.